So, how is the Fed going to affect the money supply? Well, they're not going to do it by directly printing money because the US Mint does that. The Mint is still in control of cash and coins. Although, admittedly, the US Mint tends to give the Fed whatever the Fed wants. They don't have to. The Fed has no authority over them, but that just tends to be how it goes. No, the main way the Fed is going to affect the money supply is by affecting the money multiplier, by affecting the rate at which banks loan out money. And it's going to use what's called open market operations to do that, which is why the Open Market Committee matters. So let's say that the Fed wants to increase the money supply, do some expansionary monetary policy, just like how, say, Congress would use a stimulus bill to do expansionary fiscal policy. Well, one way that they could do this, the main way they would do this, is by offering to buy short-term government bonds called treasury bills or T-bills. So, talking government bonds, that already came up in the corporations lecture. It's little debts, right? It's little debts where you loan the government money and the government pays you back at a later date. But you can also, sell these on to other people. If you're willing to give up some of that interest to, cash in now, you can do that. Well, when the Fed wants more money in the world, what they'll do is they'll buy these bonds and they just raise the account of the bank that buys the bill from them. Wait, what's that? They just raise the account? Isn't that like counterfeiting? Isn't that like a scam? How can they just make up money? Well, they do. They do. They have this ability. They're allowed to just, in their ledger, write down more cash, even if the cash doesn't actually exist. But the Fed does also keep its own pile of savings as well. Then the bank, having sold them the bond, having exchanged the bond for cash, the bank is going to use that cash. And that now they can start loaning that money out as part of its reserves. Well, there's more cash to loan. The supply of loanable funds has gone up. The interest rates go down. And hence borrowing goes up. The money supply increases as more loans are made. Suppose the Fed wants to decrease the money supply. Well, then it's to do contractionary monetary policy. Well, then it's going to do the opposite. It's going to sell T-bills. So the T-bills that it already has bought, it sells back to the market. So we give you the bond, you give us the cash. Now, if the money was sitting in a normal bank account, it would still be part of the money supply because, again, banks loan out the money that's in those accounts. But when the Federal Reserve does this, they don't loan it back out. They're more like the example I think I used with you when I was explaining fractional reserve banking. The farmer who buries a sack of gold underneath his chimney. They're stowing it away where it's not being used, where it's not in circulation, where it's not affecting prices. And so this is a way that they can kind of draw money out of circulation. You might imagine this a little bit like, say, pumping water out of a hole. There might still be the same amount of water in the world, but you're removing the water from one body and putting it somewhere else so that you can control the level. If you needed to, you would add it back in to raise the level back up. Now, T-bills are kind of the basic blunt tool that the Fed can use. If they need to make more dramatic changes to the economy, if they need to do a big expansion in response to a big recession, or if they need to do a big contraction in response to a big boom, that's what they'll use. But for fine tuning, they're going to use what's called the federal funds rate. Now, you all know how there are different interest rates for different lengths of loan. And oftentimes it seems like the shorter term debts actually have higher rates. So if you get a mortgage or a car payment, that's the type of debt. You are, what a mortgage is essentially is it's a debt where they buy the thing on your behalf, but you don't actually own it until you pay it off, right? They keep the property as collateral so that they can take it back if you try to screw them over. Well, those tend to be low. Credit card debt, that's a fair bit higher. Payday loans, you're talking like every 2 weeks, that's pretty high. The Federal Reserve will give overnight loans to private banks. I don't know why. I'm not a financial economist. I don't study this stuff as my main field. And I frankly, I have a hard time understanding why anybody would need a loan overnight. But apparently they do, because they make a very brisk trade in this. And the interest rate that the Federal Reserve charges is called the federal funds rate. So this is how they're going to make very quick tweaks to the economy. Kind of just smooth things out from day to day. Now, something to keep in mind is that even though individuals may choose to be rationally ignorant of future changes to, say, the price level or taxes or whatever it may be, businessmen, they generally don't. For them, this stuff is literally their whole life, right? They're making their living off of this kind of thing. And so banks are usually going to factor in inflation into their own interest rates. And so one big problem with monetary policy is that even though the Fed can start immediately changing the money supply by doing this, it's mostly going to work in the short term, not the long term. If the banks know that the inflation rate's going to go up, they're not necessarily going to loan as much because they know that the value of the money that will be repaid to them will be lower. And you can get into other problems. So for example, sometimes the federal funds rate can be so low, near or even below zero, that the Fed can't stimulate the economy anymore with it. Keynes described this problem. I gave you kind of more of a historical argument for why he believed that we should intervene, but he also had arguments based around certain traps you could get into, things like a liquidity trap, where the economy has essentially stalled out and it's impossible to bring it back on its own. Nobody's doing business with anyone, and so there's no basis for it to start to equilibrate. Well, in emergency scenarios where the economy is looking more like that, the Fed can use what's called quantitative easing, where it starts to buy up long-term debts that it normally wouldn't. So they'll start doing things like buying loans that banks have made to companies. They'll start buying stocks. They'll start buying anything that they can get their hands on if it pumps money into the economy. And there is a very big downside to this in that it raises inflation while also raising the value of the asset they're buying, right? It's essentially a positive demand shock. They're adding their own demand onto this asset, drives the price of it up. But the inflation that the expansionary policy creates hurts everyone. And so the owners of the assets become wealthier, but everybody else becomes poorer. Now, we'll talk about a few problems with monetary policy. So one major problem with it is that the Fed has this whole premise depends on the existence of the money multiplier. The whole premise of monetary policy depends on the idea of fractional reserve banking, but the money multiplier can vary wildly. And especially, it's mostly driven by the feeling of the banks themselves. The Fed doesn't force banks to borrow from it. Now, if you're a businessman, when do you want to ramp up your business? In a boom or in a recession? If it's a recession, you're going to be more cautious. And so too will the banks be. And so now this is kind of like the whole issue of the crowding out effect with fiscal policy. At the very time you need a big money multiplier, you're going to have a smaller money multiplier. Now, thankfully, again, the Federal Reserve is a banker's bank. And so it has a very close working relationship with private banks. Trust is going to be a very important part of the Federal Reserve's functioning. It has to have a financial industry that trusts it so that they will actually make the loans that they need it to make when it's time to expand. But if a central bank loses the confidence of its financial industry, it's not going to be able to effectively stimulate the economy anymore. And this is the case in a lot of third world countries where their central banks are less independent than ours, and their cultures are far more corrupt than ours, at least were in the past. To the point that businessmen do not trust the authorities. You see here on the graph an example of different money multipliers. So, and different, scales of intervention. It's possible to go overboard, right? You can go too far with expansionary policy and overshoot your goal. Another big problem that the Federal Reserve has stems from a thing called its dual mandate. So back in the day, and by the day, I think it's like the 1950s, Congress gave some instructions to the Federal Reserve. They said, you are supposed to focus on balancing unemployment and inflation. Why is this? Well, think back to your Keynesian model. Whenever aggregate demand goes up, inflation goes up, but unemployment goes down. And whenever aggregate demand goes down, inflation goes down, but unemployment goes up. There's essentially a trade-off. Now, there are ways that a government can reduce unemployment and also reduce inflation, and that's through real growth. If your long-run aggregate supply increases, if you become more productive as a society, if you're a better business environment, if you have, say, lower taxes, more infrastructure, all of those nice things, a better educated workforce, then you can attack both problems at once. But the problem is all of that stuff takes time. And very often, there's a reason why you're not doing it. I mean, there's a reason why the government chose to have a certain regulation or why it chose to have a certain budget. What's a lot easier is promising people a quick fix that doesn't immediately require sacrifice. It's easier to do fiscal policy and monetary policy. But the downside is monetary policy and fiscal policy, aside from that, they can't make you better off in the long term. They're like medicine. They're meant to heal you in the short term, not, you don't live on it forever. But it also has this flaw in that you're forced to trade between two different problems. If we're growing the economy by spending more money, yeah, stuff's going to be more expensive. People will have more jobs, but it's going to be more expensive. You're pumping more money in. If you're sucking money out, stuff's becoming cheaper, but people aren't buying as much of it, and people are going to, lose work. Well, this is why the Fed's supposed to have a dual mandate. Don't try to fix everything. There's always going to be unemployment. There's always going to be inflation. You need to take a middle path and just keep both of them at acceptable levels. But this is what it does. So remember that I said they're independent. But the problem is they are still appointed by the president. And there's still a great deal of kind of social pressure, of political pressure to do what the president wants. And what does the president, and when I say the president, I don't mean Biden or Trump, I mean any president. What does any president want more than anything? To be reelected, to score political points for their party. And that means fix the current problem and kick the later problem down the line. Because when that later problem, blows up under the next president, it's probably going to be the opposite party, and they're going to catch all the blame for it, regardless of if they did anything. I cannot tell you how many conservatives do not realize that the inflation now comes from the stimulus checks that Trump signed. Y'all get that, right? When they printed up a bunch of money, started handing it out to people, it takes a while for the inflation to kick in. It takes a while for it to circulate. Biden didn't do that. Biden maybe would have done even more of it. Made it even worse if he had been in power, but that's not a partisan thing. Both parties voted for that crap. They voted for it because, the state governments that shut down everything had them by the balls. I'm going to stick a gun to my head and, I'm going to pull the trigger unless you pay me a bunch of money, was kind of the tone of it. But in practice, what the Federal Reserve has tended to do is it tends to overreact to the current problem, setting up a future problem. In times when there has been a lot of inflation, like, say, the 1970s or now, they've tended to overly focus on reducing the inflation, which then causes recessions down the line. When there's recessions, they tend to go overboard and end up causing more inflation. So once again, Keynes wants to smooth out the business cycle. But if the Federal Reserve is overreacting, then they're not really smoothing out the business cycle. They're just shifting the business cycle and making it wilder. And this one I already kind of brought up, but since inflation benefits people at the start of the circulation, expansionary monetary policy, especially quantitative easing, but including all of it, is going to make bankers richer and everyone else poorer. You might cut short the recession, which is good for everybody, but you also increase inflation, and that burden's going to fall on everybody. But the people that got to make the loans, the people that got to have higher profits before the inflation set in, they don't suffer at all. It's a win-win for them. And so you end up getting a more nuanced view of it. Monetary policy is very fast, snappy, and effective when we compare it to fiscal policy. We can implement it quickly. It's generally more reliable. It's generally less corrupt in the sense that you don't get the pork barrel spending. But it also reinforces inequality in a very unfair way. And every time one of these disasters happens, we get another bout of it. The rich get richer, the poor get poorer, relatively speaking. But one of the worst issues with monetary policy may be that it could actually cause the business cycle itself. Now, that's an alarming idea, isn't it? I've been teaching you Keynesianism. I've been saying, Keynes says this is my solution to fix it. But there are economists who say, your cure is what's causing the ailment. Because even before Keynes created his more elaborate and formalized theory of this stuff, there was already a concept of stimulus. It just didn't have all of the grounding, But to explore this, we're going to briefly turn our attention to a heterodox, a non-mainstream school of economics called the Austrian school. And as the Austrian school economist Friedrich Hayek argued, Keynesian monetary policy would actually cause business cycles instead of fixing them. I'll see you in the next one.